Welcome, everyone. It's coming up on 10 o'clock. We'll just get started here in just a moment. And you're listening to Clear Vista Financials. We call it Clear Vista Perspectives. And this is our monthly update that we have regarding the markets, kind of our perspective on different things that are going on. Got a lot of different data going on here today. I'm going to go ahead. I'm joined today. I'm Mark Trice. I'm joined today by Jesse Hamilton, one of our financial advisors here in the office. And we're going to cover a lot of topics today. So we'll go ahead and get started. I'm going to stop the video here so you don't have to look at us. You can watch the slides. And let's go ahead and get started, Jesse. Let me get to the next slide here for us.
Great. So it is officially June and
the meteorological start of summer, I heard.
Yeah, I guess so. But 30 more days and we'll be halfway through the year. Can you believe that?
That's kind of scary.
But today we're going to talk about our May index performance. It's just the last month. We'll see how our major indexes are doing. We will dive into some market commentary. We'll talk about the economy and all the interesting things happening in our country and around the world right now. We would be happy to answer your questions. So we have a new and improved way of interacting with you, and you can send your questions to info@clearvistafinancial.com, and we will answer them at the end of the program. So we'll have a dedicated time at the end, and we would love to hear your questions and answer them as best as possible.
Okay, great, Jesse. Let's jump on ahead and we'll look at this. Send those questions to info@clearvistafinancial.com. We'll be happy to get back with you. Yeah. So let's jump into the S&P 500, Jesse.
So our first index is the S&P 500. This is the cap-weighted large cap index in the United States, the 500 largest companies. That index was plus 0.28% for the month. That's pretty much flat. It peaked on May 30th at 4231, and it actually did momentarily broke through that 4,200 support that we've been talking about. It was resistance for many months going back to April, but notice how flat the trading was during May. Very similar to April, very little movement, and you could almost draw a line through the entire month.
Yeah, exactly. And if it hadn't been for the last 3 or 4 days of the month, we would have ended the month negative on the S&P 500.
Right.
So basically what's happening is the market's not going anywhere right now.
Right. It is being volatile as well. You'll see that it fell 2.92% right there at the beginning of the month. The first few trading days were negative. Then it rallied about 4.5%, and then it fell back to be flat for the month.
So for those of you who have never watched one of our Clear Vista Perspectives monthly updates, we use a lot of candles in looking at our charts and things. And so a green candle on the screen is a positive day, a red candle is a negative momentum day. So What about the NASDAQ, Jet?
So the NASDAQ is being fueled by those same 6 companies. The index was plus 5.83 during the month of May, and it has upcoming resistance of 13,100. That goes back to August of 2022. But we're going to dive into all of these mega cap companies later in the presentation, but they are showing strength, including the largest chip maker in the world. We won't name it by name, but we all know who that is. And that company created the single largest gain in market cap in a single day. Isn't that crazy?
Yeah, it was kind of crazy. And the crazy thing about it, Jesse, was that they had just reported that their revenues fell short by 13% on their quarterly earnings.
Right.
But they forecast that revenues would increase quite dramatically for the remainder of the year. And that's the only thing the market heard. The fundamentals are not really there for this company to perform the way it did, but it drove all the indexes. And that's what caused the NASDAQ to really go up quite dramatically in the last couple of days of the month.
Well, one more quick factoid for you, Mark. Despite all this positivity that we're having in the tech companies, this index is still down over 20% since its all-time high in November of 2021.
2021, yeah. So we're still nowhere near the levels that we saw prior to 2022.
Exactly. That just shows how far we fell last year.
Yeah.
So the Russell 2000, this is the small cap index, and it was also fairly volatile in May. Minus 0.082, I would consider that relatively flat. It had a minus 4.5% swing between the 523 high and the 531 low. So yes, it was volatile in May, but it ended pretty much flat. May started off with a 3.6% drop, which you can see there in the first few days, and then it rallied. But between 523 and the end of the month, it reversed 4.53% in a week.
Yeah. And the small caps have really been lagging. And this is something we'll talk about in just a second when it comes to the breadth of the market. But we really had hoped to see small caps rise with the large caps, but they have not. What about treasuries, Jesse?
So this is very interesting, Mark. The long-term treasury index, and that's supposed to say May, this is for the month of May, was minus 3.26%. The first day of trading in May, Mark, this index dropped 3.13%.
Which is huge when it comes to treasuries, because you don't see that type of move unless there's a dramatic increase in yields.
Right.
And so if I can, let me turn the camera back on for a second. I'm going to get a pen here and kind of explain the relationship between bonds and interest rates.
Mm-hmm.
So I'm going to put this on the screen. And one side of you think of a teeter-totter. One side of the teeter-totter is the price of that bond. The other side of the teeter-totter is the coupon or the interest rate, the yield that's paying.
Mm-hmm.
And what we saw in April was that interest rates were rising on this side of the teeter-totter, causing the prices to fall. And that correlates to a quite dramatic change in that. We're not seeing the bond market respond the way that we think it should be if we're really going through a recovery.
Right. And since the close on the last day of April through the low there in the third week of May, this index was down over 6%, Mark. So, I mean, imagine the impact that could have on someone's portfolio.
Well, and folks that probably maybe you haven't looked at your year-end 2022 statements. If you're holding a typical portfolio that might, if you're near retirement and you're holding 40% bonds in your portfolio, folks, at one point in October of this last year, the long-term treasury index was down 40% year to date. And so that's a dramatic change, and we still have not recovered from that type of thing there. So we want to be cautious of any type of interest rate sensitive type investments. Okay. So the bond market, which we know is going to be heavily affected by the interest rate decisions of the Fed. And we're going to get to that in our macro conversation here in just a moment. But let's take a look, Jesse, at that 6 months trailing S&P 500, if we can.
Yeah, so we always like to back up and show the last 6 months of the index. So this goes back to December of last year. It includes the February 2023 high, and it just gives a little more perspective on just the 1 month block that I've been showing. So I drew the red line there at 4,200, which has been the key resistance over the last few months. And we'll continue to use this line in the coming weeks.
Yeah, we just haven't been able to stay above 4,200. Now, as we're talking today, it's getting close to 4,200 again, but that's a significant portion of that. If we can stay above the 4,200 level on the S&P 500 for several days, we think we might have ourselves a level of support at which the market can continue to rally.
Right.
Now, that February high was not the February high all time. That was just basically year to date.
Exactly.
And that's still not above, I believe, the August highs that we saw from last year.
That's true.
So the good thing about this is the pattern's beginning to form, which what we feel might be the bottom of the market. We got some other things we'll show you in just a moment. You know, we can't predict the future, but these technical patterns can provide some insight for overall market sentiment. Now, if we do have another sell-off this month, you know, that consolidation pattern from December of last year will be a key level of support.
Yes, it will.
So we just look at those things. But one thing we're concerned about right now with the overall health of the market is the divergence between the Russell 2000 and the S&P 500. The top color green and red line on the chart here is the S&P 500. The blue line is the Russell 2000 index. Now, see how through January through really mid-February, or really the beginning of March, these two indexes really mirrored each other somewhat. And then through the middle of March through today, those indexes were diverging, meaning that the large cap companies, the S&P 500, were outperforming significantly the Russell 2000 type small cap companies.
Right.
we'll cover this in a little bit more depth here in a minute, Jesse, but I wanted to point that out.
Yeah, that's great.
As an indication of the lack of breadth. In fact, I looked this morning, and the percentage of, at the end of the month, the percentage of companies on the S&P or the NYSE that were trading above their 200-day moving average, which we consider a level of health,
Yes,
was only at 34%. So roughly 66% of all the companies trading on the S&P 500 are underperforming the 200-day moving average. They're not healthy, and we'll get into some additional things there.
So that's the end of our index performance section. But Mark, let's talk about some market commentary.
Yeah, sure. Let's jump into that a little bit. I want to talk about some of the continuing headwinds. Now, the debt ceiling extension, we'll talk a little bit about this in just a moment. But today, we believe that the Senate will vote to approve the bill that came out of the House yesterday, and hopefully that debt ceiling thing will be lifted. Federal Reserve interest rate hikes, there's a lot of information there. The lack of breadth of the market, we kind of touched on it just a little bit. We still have inflation, folks, and it's still pretty high. And this might result in some tightened lending, and we're going to cover a couple of different things when it comes to money supply here in just a moment. So these are headwinds that are facing the stock and the bond market this year. And we're going to cover both of these, but we'll focus on the top three for today's presentation. I might mention something about tightened lending if we have a little time, but let's go ahead and jump into that. So Republicans in Congress used the threat of a catastrophic default on Treasury securities if President Biden didn't agree to cut spending. Now, in the end, Republican negotiators agreed to raise the debt ceiling. Now, actually, they didn't raise the debt ceiling. They removed the debt ceiling for the next 2 years. That's a key distinction, meaning that our government can spend whatever they want for however much they want for at least the next 2 years. So there is no debt ceiling anymore right now for 2 years. It's been suspended. We can issue debt like crazy if we want to. So I don't think that's a good thing, but apparently that was a big win-win, supposedly.
Yeah, this is in progress right now. You'll probably see a headline in the next couple of days of this being presented to President Biden and moving forward.
And the thing is that there's two lessons here. And the first is, as politics have become more polarized, both parties, the Republicans more so, have reached for financial tactics once seen as off limits to achieve their goals. But even as these tactics become more extreme, the goals have drifted further from controlling deficits and debts. Yeah. So this whole debt deal was not really anything about controlling spending or debt or limiting the debt. It's just about basically power. And I've been really disappointed in this conversation about the debt ceiling because we're not really doing anything significant to limit government's ability to spend. Right. Like I said, it passed the House yesterday. The Senate should be voting on it as early as today. So they're really, I spent 7 years in Washington, D.C. Many years ago. And what I quickly realized that Congress and the government thrive on drama. The U.S. was not going to default on their debt. Right. Okay. So despite the headlines and despite the things to make you worry, U.S. was never going to default on their debt. But you can't take it. You always have to take advantage of a good crisis, right? Yeah. And so if we keep everybody worrying about what's going on, then people will respond to government's calls to do whatever they want. So
what does hold them back if there's no debt ceiling? Is there any fail safes?
None.
Okay.
None. No, because it was a complete suspension of the debt ceiling for at least 2 years.
And that just gets them through the election and everything.
Right. It takes them through the election. So nobody has to be accountable for anything through the election, which government folks in Congress love, because if they don't have to be responsible, then, Right. So this chart compares the current rate cycle versus other major rate changes over the last few decades. Okay. So the current cycle is the black line on the top. This is where the Fed is raising rates and so forth. So you'll see the 1989 path in light blue and the 2006 path in dark blue. This shows how aggressive this rate hike increase has been over the last 16 months. Never has the Federal Reserve raised interest rates so fast. And that's what caused a lot of the shock in the bond market last year.
Right.
And there's no way really to predict what the future is going to be. Now, I've got some thoughts about that. You know, the Fed will meet again on June 13th and 14th. 14th is when they'll have their presser and announce if they're going to raise rates. There's a lot of regional Fed presidents that are putting out there that they're probably going to raise rates again. Now, the market is pricing in a rate cut by the end of the year. And so we don't see that as realistic, though.
No.
And if the Fed decides to pause, in other words, they do nothing, I think that's not that pivotal. I don't think it's that big of a deal. They're just waiting to see what's going on. Now, I have to go back to the debt issue. We don't have a slide on this, but when the debt ceiling is lifted for Congress, the Treasury has to replenish its balance sheet.
Right.
And so what they'll do is they'll issue lots of short-term Treasury T-bills
For cash flow.
And over the next 3 to 4 months, that's about $750 billion
With a B, yeah.
that's going to be sucked out of the money supply. Now, we've had money supply dropping for 5 straight months, and we've never seen it drop this fast. Now, remember, money supply dramatically increased in 2020 and 21 with all the stimulus, okay? And so this is critical. We're already seeing this. And what we've been told by our economist friends is that issuing another $750 billion of T-bills in a short period of time has the same effect as a 0.25% interest rate hike.
That makes sense.
And so that will tighten the money supply, which will tighten credit availability for businesses to expand. So, you know, we can defer to Newton's laws, right?
Sure.
For every action, there's an equal but opposite reaction. The Fed can't raise rates as aggressively as they have and not create some sort of consequence for the economy.
Right.
We can't print that much debt and not have some type of consequence for the economy. It's their goal to reduce inflation and create stability, but we might have to weather a recession to get there. And we'll talk about that.
Sure.
So this is the Treasury yield at the end of May. And on the left-hand side of the chart is the shorter term treasuries and T-bills and things. On the long side is the 30-year treasury bills, treasury bonds. And you can see that yield curve is still inverted. We want this yield curve to be the opposite. We want the long-term treasury to be at the top of the chart and the short-term treasuries toward the bottom of the chart. So it's still inverted.
For those of you watching the Stanley Cup, we want it to look like a hockey stick.
Exactly.
Low at the bottom and high at the top.
And we've talked about this, you know, and an inverted yield curve is a precursor for recession. Every time it's happened in the history of the United States, there's been, and you had an inverted yield curve, there's been a recession shortly thereafter. Does it mean that we're certain for recession? No, because we don't have a crystal ball, but it's a pretty good indicator, okay? So you will see the 3-month yield here is around 5.5%, and the 30-year yield is 3.9%. That should be kind of reversed there with that. Okay, so what we're concerned about here is, okay, if we don't pass a debt deal, which we looks like we will, that might cause a spike in short-term interest rates. And so that's fine if you're holding short-term treasuries, short-term T-bills and things like that. Yeah, that's good. But there is some concern that money markets might be vulnerable if the Fed does not pass a debt deal, which
you'll see there on this year, it's still north of 5%.
That's right. And that spiked up in this year and still climbing. And it kind of depends on what happens with the Federal Reserve next week.
Right.
So this chart shows the New York Fed's probability of a recession in the U.S. within the next 12 months, and it's gone up quite a bit. And they predict that that's around April 2024. 68% chance, and this changes all the time, but it's just something that we look at and watch there. So on the consumer side, here's where concern we're seeing, where people are draining their savings. And we're starting to see an increase in loan delinquency on auto loans and credit cards and even mortgages and so forth. And at the same time, we're seeing higher rates on credit cards. And that's hurt a lot of families. And higher mortgage rates have kept some from buying a house.
Mhm. We
We think that the housing market will recover sometime this year and actually have a healthy recovery. What we're concerned about when it comes to commercial real estate.
Sure.
And there's a lot of pundits out there that are saying that could be a problem in the near future. Okay. Let's talk about that breadth of market. We showed you the divergence between the S&P 500 and the Russell 2000 index. All right. So Ned Davis research reports that concentration inside the S&P 500 is just really 5 stocks, and that's what's moving the index level. So when we had last week, when we had a couple of really strong days in the market, it really was 5 or 6 companies that were pushing the index. At the same time, we would see the small cap index actually fall.
Right.
And we're also, if we compare the S&P 500 index, which is all cap weighted, meaning the largest companies drive the index, to an equal weighted S&P 500 index, we see that same divergence, meaning that the smaller companies on the S&P 500 index are not pushing the index higher. In fact, they're dragging on it.
Right.
And that's a concern. We're not seeing that breadth of market here.
It's only the 5 stocks that are representing a quarter of the index.
Yeah, that's right. That's what this orange part here talks about, is how much that makes up the index. And that's concerning. Now, what has to happen here, Jesse, is that, and I'll show that equal weighted index compared to the S&P in just a minute. What has to happen here is either the large caps diverge and come back to the mean. In other words, they fall in value, or the small caps rise up to meet the average of the large caps.
Right.
This is basic statistics, right?
And I think we have an answer to that later in the slide, but yes, continue.
Yeah. So we're watching to see what will happen there. And we don't know exactly what that's going to look like. But let's look at that overall breadth in the market. Here's the 3-month performance of the S&P versus the equal weighted S&P 500 index. And what you can see is that the S&P 500 cap weighted index is outperforming the equal weighted index by more than 5 percentage points.
Right. And it's been a long time since that's happened.
Yeah, that's right. And so, we just see these larger companies moving the indexes more and more. Okay. Here, and we have to talk about the fruit company. We can't say the name, but here it is on the slide and stuff. Apple has surpassed the market cap of the entire Russell 2000 index, which is huge. And that's greater than some of the international indexes and the entire Toronto Stock Exchange. That's to say that Apple's 2.7 trillion market value is greater than the market value of all 2,000 companies in the Russell 2000 index.
Wow.
Now, this is not a performance comparison at all. It's just a size comparison. So we're not talking about performance. We're just talking about size. But this further explains how these mega cap companies have so much influences on the indexes as a whole. Now, here's some positive news.
Yeah.
Jesse, Piper Sandler research revealed an interesting relationship in market returns and dispersion between the indexes. What we've been talking about here.
Yeah.
So they saw that the NASDAQ Composite Index has significantly outpaced the Dow Jones Industrials Index by over 20% year to date. And that's also the equal weighted as well. History suggests that this is bullish for equities. Now, we don't have a crystal ball, but we like to see positive signs and wherever we can. This wide differential between the NASDAQ and the Dow Jones Industrial Index has happened only 4 times since the 1970s. This chart that you see on your screen below identifies every occurrence when the NASDAQ outpaced the Dow Jones Industrial Average by at least 10%. And there are 13 periods when this occurred. Now, that's the green circles on the screen. Is that right, Jesse?
Yes, that's true.
All right. So it's the green circles on the screen. So there were 13 periods with occurred. And then when considering prior bear markets defined as a price decline of greater than 20% off its high, and simple moving average crossovers, periods of NASDAQ outperformance versus the Dow Jones have broadly been a bullish sign for equities. Now, we don't know what the future holds, but this could be a positive sign.
Yeah, that's good news.
Yeah, take our positive sign. Let's go for a more negative one. So we've been watching the cap weighted indexes outperform, right? And so the equal weighted indexes for the past several weeks.
Yeah.
And the small caps continue to show weaknesses. Now, remember that overlay chart, Jesse, that you put up about showing the difference between the S&P 500 and the small caps?
Yeah, the
Okay.
S&P was on top and the Russell was the blue line.
So this chart is from Bloomberg and Wells Fargo Investment Institute. And so it's showing the rising number of what we call small cap zombies. People are using the word zombie a lot more, I've noticed.
It's a rising term in the industry.
Yes. So by zombie, we mean smaller publicly traded companies that exist in the Russell 2000 index are there, but they're not profitable. They're present, but they're not alive. They're zombies, right? The red bar is the current level of these zombies compared to the 20-year average. We're seeing this mostly in small caps and some in mid caps as well. So right now, the current value of the Russell 2000 index, and this is the price to equity value here, is over 40%. 40% of those companies are companies in the Russell 2000 that are not making money.
That's concerning.
A profit, yes, a profit. And then it's the 20-year average for the Russell 2000 is around 30%. So every one of these, the Russell Mid Cap Index, you can see the same there, got a lot of zombies running around. This is very interesting. We want to watch because ultimately, prices in the market are reflective of the fundamentals of the companies in the market.
Right.
And if we're seeing 40+% of the small cap companies not actually making a profit, that's concerning.
Right.
Okay. Has to do with that market breadth. All right. So what does this mean for you? As we enter the summer, we encourage you to use the change of pace to take action on your financial journey. We're always here for you to help navigate the world of financial planning and risk management and so forth. And we don't want you to think we are negative or extremists when it comes to the economy. We think there's just a lot of headwinds ahead, as we said in that comment we had earlier. And it's going to be a little bit bumpy for the foreseeable future. But this is why we call it Clear Vista Perspectives. So what does it all mean for you? Well, we always encourage you to check your statements, talk to a professional. If you don't have a professional financial advisor that you're working with, Jesse and I would be happy to talk to you about those things. And I'm not seeing any questions on the board, but you can always send us a question at info@clearvistafinancial.com. Let me put that address up here. Or you can call us at 800-491-4508. We're always happy to schedule you a complimentary consultation. I've got the link to my calendar on here. So you can just click on the button there and schedule a phone call or come stop by and visit us at one of our offices in Central Texas. Jesse, is there anything else you want to add to our commentary perspectives today?
No, just thank you so much for being a part of this. If you want to talk about anything in this presentation, I know it was data heavy. If you have a question, just give us a call. We'd love to hear from you, and we appreciate you being a part of it today.
Thanks for joining us.